So in today's lesson, I want us to study about horizontal liquidity. And for us to understand this lesson better, I want us to have a look at one of the oldest trading strategies, that is equal highs, equal lows, based on to the retail traders as triple tops, bottoms, double tops, bottoms. So assuming that you are a trader and you get to find this market in this kind of a scenario, where the market is revisiting a specific point for the second time, the chances are they not that you're going to buy from this area? Just a second so that you can answer. The highest chances are that you are going to buy the market from this area. But what happens in the real sense? That the market comes to your reacting point where you wanted the market to buy from and also gives a convincingly buying move, only for the market to buy some few pips for you and turn against you to react from a point after taking you out and now proceed in that very direction where you wanted the market to go. So kindly stick to the end of the lesson. We are going to identify some of the problems that are faced by the traders and also give the possible solution to these problems. Let's go. Please, if you're finding value in these lessons, ensure that you subscribe, like, and comment your thoughts. Thank you. So this specific trading strategy is one of my favorite trading strategies. That is a strategy that I use most of the time. I think based on my weekly analysis, you have all seen that. So I always trade oil and gold. So my analysis is going to be based on those two instruments. Can also work for any other instrument, but that is when these are the instruments where it can work best. So kindly let's just have a look at two different scenarios where we have equal highs, double bottoms, double tops, or equal lows, highs, that is triple tops, triple bottoms. So in this first scenario, as a trader, what are you going to do if you find the market in this first kind of a scenario? That if the market bounced from a specific area for the second time, or maybe for the first time, in most cases, the first time is always the watching phase. So assuming that the market reacts from this area for the first time, comes back to the exact point for the second time, what are the chances of you not buying the market the very time when the market is coming from this? The chances are definitely you're going to buy, because we have that I say about history tends to repeat itself also in the charts. That is what we are taught, that in most cases, if the market turns from a specific point once or twice, the market is also likely to bounce from that specific area. So the market comes to this area, convincingly buying to a specific point, only to turn against you, take your stop losses out, and react from a possible scenario. This is a case where we have what we call the equal highs loss, that is triple tops, triple bottoms. Now, I want us to have a look at the second case where we have the double tops. So in this case, what will a retail trader do? If the market approaches a point, turns from the specific point and revisits the specific area for the second time, the chances are a retail trader would always sell a double top and always buy a double bottom. So in this case, the market convincingly drops from the specific area where the trader wants the market to sell from, and it convincingly sells from the specific area. And then maybe they would enter the market at that, around this point, and also their stop losses will be somewhere around that specific point. So what will happen? The market will just give him some few pips in profit, turn against the trader, and react from a specific area, and also proceed to that very specific direction without that retail trader. So now that we have this as a possible scenario, I want us to have a look at the chart and maybe get to see a real chart scenario where this is happening. And maybe after that, we are going to give a solution to what a retail trader is supposed to do for him or her to make something from this mysterious market. Keep going. And if you have not yet subscribed, ensure that you have subscribed, because you will always be notified every time when we come up with a lesson like this. Thank you. Just take a second to answer this. Assuming you are a retail trader and you find the market in this kind of a scenario where the market bounced from a specific point and it has revisited that very point the second time, assuming that this is the unknown move that the market was to make, what would you do? The chances are you're going to sell the market, right? This is a case where we have the double tops. So the market will always react from that very specific point, and based on the classic chart patterns that after the market breaks the neckline and blah, 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 such a kind of a scenario, then you are likely to sell this market. Maybe let's say after a confirmation like this confirmation with this very long bearish candle, you're going to sell the market at this very point. Then definitely your stops will be slightly above the tops. What will the market do? The market will just stand against you, take your point out, react from a specific area, and continue downwards without you. That is the first case. This is now a live chart, US oil chart. The second scenario, what would a retail trader do in this scenario? So the market bounces from this point, goes up, revisiting the same area for the second time. So yeah, sorry for that. It should have been. So the market forms a point, bounces from the specific area and revisits it again. What are the chances of a retail trader selling the market? Are very low. What would a retail trader do? Would maybe look to buy the market exactly where we have the double bottoms. So only the market confirms, because like in this case, we have the famous candlestick pattern. We could call this maybe an indecision candle followed by a bullish convincingly candle. Then we are most likely to buy the market from this very point. And maybe if we have the stop losses should definitely be slightly below the loss. Then the market just gives you about 10 to 20 pips, turns against you, takes your stops, and then goes right against you. Now that we know this kind of, okay, we can have one last example about the same. Now, this is a long-term example, and this is the last example. So the market is reacting from a specific point. Let's say that point bounces from that, revisits the same area, maybe over and so many times, that what will happen if the market comes back to these equal points? And is it not that the retail trader will be looking to buy from this very point? Then what are the chances, or what would I advise in this kind of a scenario? Let's now go to the solution part of this kind of liquidity. Now that we know a retail trader, after the market forms these double tops, they are most likely to sell the market, expecting that the market is going to drop lower. Then the solution is always identify an order block above where the market is making the stops. These are what we call now inducement. Above where the market is inducing you to enter the market early, always slightly above, there must be an order block. Like in this case, this is the candle that we are supposed to pay attention to. That within this candle, there must be a reaction. That is why the market immediately after retail trader entered the market at this very specific point, the market pulled back to the order block before proceeding to that very specific direction. That is the scenario. So we are going to check the exact examples that we give and get to see if the exact applies. If above the inducing point, whether above or below, depending on the direction of the market, whether there is an order block where the market is most likely to react from. The first case, we have that one. Let's have a look at the second case. So we say that based on this very candle, because people are now misusing smart money, that you were most likely to buy from the area, and the market convincingly gave you this very move that it is going to buy. But slightly below that, then we have this very order block right here that we are supposed to pay attention to. And that's why the market pulled back to that very order block before proceeding to that very specific direction. So let's have a look at the last case. Now that this is the current chart in US oil. So we said a retail trader will most likely look to sell if the market revisits this very area. But now slightly below this area, do we have an order block? And the answer is obviously yes. We do have this very candle right here. Let me just expand this. We have this very candle right here, where the market is most likely to react from this red candle in between the candles. That is what we call the inside candle. So we have the probability of the market dropping all the way to that point, and that is exactly what I'm watching, or I'm paying attention to the current oil chart, that the market is most likely to drop to this area and then react from this. But it is most likely to induce the traders to make sure that the retail traders buys from this point, so that if they drop from here, they cannot afford to survive the drop. Now the bonus lesson will be about diagonal liquidity. So kindly always make sure that you have subscribed to our channel. Let's see the way forward.